You've heard about mutual funds. You've heard that mutual funds sahi hai, or that they're good. You've heard that you should buy a systematic investment plan or SIP into a mutual fund. And you've heard mutual funds are subject to market risks. But you don't know how to choose the best mutual funds for your needs. Well, you've come to the right place. Hi, I'm Hansi, and we are talking money. In the previous video, we introduced you to some basic equity investing terms. You are basically buying and selling stakes in businesses on the stock market, where you can see all sorts of buyers and sellers making bids and offers for every stock listed on the various stock exchanges. Everyone has access to the same information about the companies, the industry, the economy. Now, whether they bother to study all of this is up to them. They have to analyze all of this information to come up with their bid and offer prices and choose to transact. All this analysis is hard work, and if you have a day job or a life, you may not want to do this. You can choose to outsource this to a bunch of experts. You can invest in an equity mutual fund, which pools your money with other investors and then lets a fund manager pick a portfolio of stocks. Of course, you have to pay all the transaction costs and also a management fee, all together expressed as an expense ratio. Assuming that they are well-trained analysts, there might still be differences in their opinions on any specific business, industry, or the whole stock market, because the analysis requires them to make a lot of assumptions about the future. That is, they are forecasting the future, which is uncertain. This is a lot harder than it sounds. So they charge a decent rate of fees, 1 to 2% per annum, which may not sound like much, but when returns are in single digits, it's a lot. And over 20 to 40 years of investing, it's hell of a lot. Let me tell you a secret. The fund managers don't get all of their forecasts and hence their stock calls right. Indeed, if they get about 60 to 70% right, they will do well compared to the market index. Remember the Sensex and Nifty reference from the last video? Now, if you're wondering why you should bother with the market index, it's because you can invest in passive mutual funds that match the market index return. And they are a lot cheaper. They usually charge only 0.1 to 0.5% expense ratio. And some of them are themselves listed on the stock exchange. They are called exchange-traded funds, and they can be even cheaper. Now, you can actually assemble a portfolio of passive funds and ETFs that should achieve your long-term goals. The active funds are really only ever meant for slightly extra return. But you know what? If it's causing you too much stress, my advice, just invest in passive funds for now. It's like painting a picture with some colors. You can paint a picture with some broad strokes, kind of like the ETFs that match the market indices, like so. Now you can add more color with the smart beta ETFs. I'll explain this term in a future video. If you want a picture with a lot of granularity, you can use active funds. But this requires time and expertise, which means more costs and lower return. If you could do this well, yes, your picture can look a bit impressive. But to be honest, you could have made the point with the broad brushstrokes. So you could have still achieved your long-term goals with passive ETFs. So how about this? Instead of worrying about which mutual funds to choose, start with passive funds and ETFs. Use the finer colors of active funds only after you learn more about them over time.